Hey, good evening, everyone. Good evening.
Good evening, Professor.
Good evening. How's everybody?
Good evening, Professor.
Hey, good evening, Awa.
Good evening, Professor. Good evening, everyone.
Good evening. All right. So, looks like I have 13 people here. 13 people, and I have. Let me check how many are in the discussion board. And it looks like I have 14 people in the discussion board. Right. So, pretty much the same. I mean, if you're in the discussion board and haven't yet joined the collaborate session, I hope everybody will soon join. Now, so today is T-1, right? I mean, our last day is next Monday. So next Monday we will meet in person. Okay, we'll meet in person. So this is the last day. So I hope to see all of you there. Um, so I don't know how much we can cover today, and it won't be, but we'll just I'll give it a try. I'll give it my best shot. But everything has been already covered, right? Everything has been covered already by the main lecture. Uh, so this shouldn't be, that difficult to you. So let's. So our current topic, our next topic is capital structure, right? And leverage. So capital structure, we've been talking about this since the first topic, financial statements. And I told you, balance sheet is all about the capital structure. Balance sheet is all about the capital structure, right? The capital structure is basically uh, equity, debt, um, and how much of the total assets is debt, right? The ratio between, total assets and debt, that's leverage, right? Uh, the ratio of equity to total assets, that's also called the equity ratio, but it doesn't have any particular name, right? The leverage is basically debt ratio, right? And why is it uh, the talk of the why is it the why is it brought back again? I mean, why is it important? It has significant impact because it has significant impact on the profit. Um, in other words, when we talked about in financial statements, when we talked about capital structure, um, it the leverage or the capital structure, in other words, debt ratio, um, you must remember that I said, 100% equity is not good. If the company is, 100% equity, I mean, if total assets, uh, if equity ratio is 1, that means this company uses no debt. But is that necessarily a good thing? No, it's not necessarily a good thing. People think, oh no, that would, then there is no default risk, right? Of course, default risk will be zero. If this is the case, default risk will be zero because you don't owe, there's no debt, you don't owe anybody anything. But that doesn't mean, it doesn't mean, it doesn't mean high profit, right? It doesn't mean high profit, right? So We already understand what it is, so I'm gonna skip all of this. There's no leverage and the leverage influences the stock price. Why? Because it influences first profit, right? It influences profit, and therefore the profit will influence the stock price. So we all know the overall measure of overall performance is basically EBIT, first of all, which is also called operating income or operating profit, right? And of course, eventually EAT, net profit, right? EAT or net profit, yeah. Company must have great EAT or net profit, and there's no doubt, there's no doubt, no controversy about it. Now, more than EAT, return on equity, because it's not the size of EAT, but it's the ratio, return on equity, EAT over equity. Why? Because think about it. If the profit is net profit, $10 billion. Wow, that must be great. But look, it depends on what the total equity size is. What if the equity was 1 trillion? Out of 1 trillion, right? 10 billion is 10 billion is just 1% of 1 trillion. Isn't that right? It's just 1%. So can you say this is a great return on equity? I mean, anyone? This is 1%, and 1% return on equity. Can you say this is a great result?
Yes, yes.
1% return on equity is a great result?
Oh, no.
I mean, obviously, even by absolute number, I mean, look at this is, basically a output to input ratio. I mean, you input 100 and you get just 1.
No.
Of course, you will have to compare it. You will need to compare it with the you will have to compare it with the industry average, right? Industry average, right? And if the industry average is 0.5%, yeah, this may be. But what kind of industry? What kind of industry can survive on 0.5% return on equity? I mean, just by simple, think about it. This is a very poor gas mileage, isn't it right? This is a very, very poor gas mileage. You put 100 gallons and you just got 1 mile, right? That's a very poor mileage, isn't it right? So even if you don't, I mean, eventually you will need to compare it with the industry average. But even if you don't compare it with the industry average, you can already tell 1% output to input ratio, 1% mileage, gas mileage, 1% mileage is a very poor performance. However, if this is not 1 trillion, but if the equity of the company is size of the equity of the company is 50 billion and the profit was 10 billion. Now this is not bad. Clearly, everyone can tell, oh, that if that's the case, then output to input ratio is 20%. So it's always the ratio. Think about it. Always the efficiency is measured by what is the best measure of efficiency? Output to input, right? It's just like your parents sent you an Ivy League school, but if you went to an Ivy League school, it costs like, $50,000 a year. For 4 years, it's going to cost your parents $200,000. After Ivy League school, let's say, but in the Princeton, let's say you went to Princeton, but um, you studied something like classics, like ancient Roman uh, classic literature. What kind of job can you land? Huh? You will probably land some library job, and the maximum income you can earn would be probably 50K a year. Then think about it. Output to input ratio is horrible then, right? You can only recover your investment, and the investment was $200,000. And so in the first year, you cannot recover it. If you spend zero, you save all the money that you make. Only in 4 years you can recover that input. So always consider input-output ratio, output to input ratio. And this output to input ratio is not that bad. You might think, this is just like that Ivy League school example. Yeah, but look, this is this $50 billion investment was probably like into the plant and equipment, fixed assets, right? Plant and equipment. I mean, making 10 billion gross, netting 10 billion, right? In other words, net profit of 10 billion out of that, $50 billion facility, plant and equipment. Not a bad thing. Okay, so one measure, of performance, again, yeah, if it is important, EAT is important, but that alone cannot tell. That alone cannot tell whether you are doing well or not. Just like the example I gave you, yeah, the profit of 10 billion, wonderful. But what if the total equity size was 1 trillion, right? That wasn't a very good thing. So you have to look at the return on equity. Also, earnings per share, which is basically what? Earnings per share is EAT, right? Profit, right? Net profit over number of shares. So even if you, so it's exactly related to also related to this. Why? Again, if the company earned $10 billion and equity was 50 billion, right? If the equity was 50 billion, then and this 50 billion came from 50 billion is paid in capital, right? It was paid in by the shareholders, right? And the question is, how many shares are outstanding? So how many shares are being held by the market? And if there are 1 billion shares, right? number of shares outstanding. If there are 1 billion shares there, that means price per book value per share, in other words, price per share, right? Book value per share, we know it's $50, right? And then earnings per share, which is 10 billion divided by 10 billion divided by 1 billion shares. That will give you $10 per share. That's the earnings per share. Again, oh, this isn't that bad, and that already even without comparing with the industry average, you can already tell it's 20% return, right? 20% return, return on equity. So not a bad thing. 20% return is it's a great thing, right? Actually, by any empirical, and then it's also reflected in the earnings per share. So even before comparing it with industry average, right? Earnings per share, industry average, right? Earnings per share. This would be wonderful thing. Usually, earnings per share per quarter, quarterly earnings, I've been telling you, every quarter, right? In the first month of the every quarter is called earnings season. Earnings season. Why? Because the previous quarter's results are in the first month of the next quarter, in the following quarter. And then sometimes you see, the earnings report barely $2, not even $2. Sometimes not even $1 per share. That's the reality. If you get $1 earnings per share per quarter, at least annually, it's going to be like $4 per share. But in general, you don't even, the reality of the market, you don't even see that. But that gives us a pretty good idea why these are measures of overall performance. But then all the returns, right? There is risk, and risk is, we all understand, it's the variance, right? The volatility is the variance. Is the variance in return. That is variance in return is also variance in profit, right? The volatility. And I've been telling you, risk comes from two sources of risk, right? One is systemic risk, and then unsystemic. Unsystemic. Systemic, that means economic system. It comes from the economic system. So it's nothing there's nothing you can do. I mean, to avert that systemic risk, or to get rid of that systemic risk. I mean, as long as you're in that. One good example. There are like 5. In systemic. In unsystemic risk, there is only 2. First of all, market risk, financial market. Now, when these days, market has been going down like crazy. I mean, as I've been telling you, the highest point, I mean, since January, market has been just on the downtrend. I can't, I've been telling you, my portfolio lost almost like 12% since January 3rd or January 9th. The highest point was probably January 3rd. But you might, can't you sell, no, this is, even if I sell, yeah, what I'm talking about, part of it is, I cannot sell, part of my portfolio is, there is, retirement, IRA, a personal individual retirement. And it is handled by the asset management firm. Your retirement fund is generally managed by some asset management firm. So those things you can touch. And my own brokerage I can sell, of course. But then when the market is overall in downtrend, and if you can't, your retirement account is managed by some, fund manager, right? You have to, you cannot sell unless you breach the contract, or you terminate that contract. But yeah, you can, at some point before losing 10%, I could have liquidated all my position and stay out of the rain, stay out of the storm. But then, while the market is going down, that's overall, the entire market was going down. It's not just one particular stock or several particular stocks or particular assets. Overall market. Dow Jones, NASDAQ, Standard & Poor's, they have been going, all of them. So overall market was going down. So when there is something in the financial market that is a huge, macro force, right? You can't avoid it. I mean, the best thing you can do is sell and, stay out of, stay out of the storm, or just weather it out. Because, this is not because U.S. economy, and I didn't sell because why? Not because U.S. economy, it's not because the U.S. economy is doing poorly. It's not because, this is, U.S. economy is doing well. I've been telling you over and over. Why? Because the labor market is very tight. I mean, the only, everyone willing and able-bodied to work all have jobs, and there are multiple job openings, and people choose jobs. It's not like, in other words, unemployment and vacancy ratio is called the Beverage Ratio. I mean, I don't know if I remember correctly, because Larry Summers, about a week ago, I think, Wall Street Journal had an interview with Larry Summers. You know who Larry Summers is? He was a Treasury Secretary under Obama administration. I don't like, I mean, I personally don't agree a lot with Larry Summers, but, I mean, in particular points, but in general, and Larry Summers, quoted the beverage ratio. What's the beverage ratio? How many Coca-Colas are being sold? No. Beverage ratio is basically a vacancy to unemployment ratio, right? And this ratio, think about it. If this ratio is greater than 1, what does that mean? If this ratio is greater than 1, of there are more job openings, there are more vacancies than unemployment. And in that interview, Larry Summers mentioned that the beverage ratio is something like 6. He said, what? Was it 3 or 6? I forgot, but if this is 6, this is crazy. Isn't it right? This is crazy. There are 6 unfilled job vacancies for each unemployment. So if you are unemployed, you have 6 jobs you can just choose from. So the labor market is very tight. One concern is the reason is almost 4 million people retired during the pandemic. 4 million people. Of course, these 4 million people, some of them must be, like in retirement age, really 65 and above, and they got hefty during the pandemic. The economy was very strong. Stock market was very good, very strong. So their retirement funds was very, had very high value. So they thought this was the best timing. This was the best time to retire with the most money. But how many of those people, but think about it, how many of those 4 million were actually, senior citizens who really retired? Some of them just retired for a better job, to get a better job. So even last year, there was a saying, is it a great resignation or great resignation or great resignation? We thought it was great resignation, but it was actually great reshuffling. What does that mean? Some of those 4 million were people who quit to get a better job because there were a lot of job offers. Well, anyway, let's say, let's be just conservative and 50% really retired, but 50% just got new job. And these days, even a couple of days ago, I read this, in the LinkedIn. I don't know if it was in the LinkedIn or Wall Street Journal. There was an article that the employers are having a hard time because not only because it is hard to fill in the vacancies, but those who interviewed and got hired never showed up. So why? What's happening? So even if you have a conservative estimate that those who actually retired were 50%, but those who got a new job were 50% out of that 4 million, that means at least 2 million retired, 2 million just switched jobs, and these 2 million, they are still, look, what's going on? Because the beverage ratio is 6, even after the job interview, they don't show up. They still are fishing for better offers. So this is what the economy. So nobody is spending less. I mean, what recession? I mean, has anybody, tightened the belt during the pandemic? Nobody tightened the belt. Even those who were on unemployment benefit. I mean, they could get a job, but they didn't get a job because they deliberately didn't get a job because they were collecting more hefty unemployment benefit than paychecks. So this is a crazy thing. You know, we never went into recession because there was no recession due to pandemic because nobody stopped, nobody lost job. I mean, there were people who lost jobs generally in the restaurant industry, tourism, and hospitality industry, but they didn't lose paycheck because they got the hefty unemployment benefit. Nobody spent less. Nobody tightened the belt. So the economy was heated, right? So obviously there was a reason for inflation because everybody's spending. Demand never went down. So the price would go up. And then coupled with supply shortage, right? And the war in Ukraine, Russian invasion in Ukraine, the energy price went up, and energy supply, dwindled. Energy supply, and then, due to pandemic, most parts and components, were coming from China, but the factories shut down, and so production went down. And then even if they had enough products, then vessels, shipping vessels, cargo vessels, hard to find cargo vessels, hard to schedule shipping, So all of this coupled with, so the interesting argument is, yeah, we never had, recession, and instead we had inflation because of, strong demand, and, coupled with, supply shortage. But then another thing is, if 50% really, which is, about 2 million people, if 50% really retired, so then GDP, the GDP would be, because 2 million people are not working, retired, the GDP would be lower. I mean, if these people didn't retire, the full employment GDP would be, let's say, this year, at the end of this year, it may be $24 trillion. That's potential GDP. The actual GDP maybe will be less than potential GDP. Yeah, well, it would be lower than the potential GDP. So that means, GDP growth rate will be lower, right? I mean, if U.S. economy grew by 4% on average, now growth rate maybe 2% or 1%. But fine. I mean, no matter how, whether GDP grows, but the problem is, inflation is much greater than. I mean, if GDP inflation is about 8%. If GDP growth is greater than 8%, wonderful. Nobody will cry out inflation. But it's because GDP is growing only at 2%, but inflation is 8%. That's why everybody's crying out inflation, right? So although GDP may be lower than the potential GDP, but anyway, the economy is there's no reason for the financial market to panic. But the financial market panicked. First of all, to fight the inflation, they raise the interest rate. If they raise interest rate, valuation, all of the asset values go down anyway. So financial market will go up. This is coming from the economic system, right? Coming from the economic system. Uh, Nothing you can do about. Second is, interest rate risk. Of course, interest rate risk is, the risk from, a higher interest rate, because that's exactly what I talked about. The value of your assets will all go down, right? All stocks, bonds, because valuation is what? It's all present value, right? Present value goes down. And then reinvestment rate risk. We already talked about this. I don't think we need to. That means, when interest rate, it's the opposite of interest rate risk, because interest rate risk is a concern when interest rate goes up, but when interest rate goes down, then you have reinvestment rate risk, because when interest rate goes down, you cannot reinvest your dividends and coupons. You can no longer reinvest it at the previous rate, because everything will have to be reinvested at lower rate. That's reinvestment rate. And then a fourth one is inflation, of course, inflation risk. And then fifth one is exchange rate risk, exchange rate. So these are basically coming from macroeconomic system. That's the source of first. And unsystemic risk is also it's firm specific. Unsystemic risk is basically firm specific risk. First of all, financial risk. The second one is business risk. Business risk. You might wonder, financial risk, isn't that same thing as the financial market? No. Financial risk is totally about leverage. This is totally about leverage. So this is more like industry specific risk. Why? Because depending on the industry, some industries are more likely to be heavily leveraged. Okay, some industries are more like one good example, an industry that requires huge investment in the equipment, plant and equipment. One good example is airlines industry. Airlines, why? Airlines consist of a lot all equipment, isn't it right? Aircraft, Boeing 747, Airbus 320. These are equipment, and then those airlines, these aircrafts are not cheap. They are like millions of dollars, millions of dollars. Maybe tens of, one Boeing 747, Airbus 320 may cost like, tens of millions of dollars. And how do they fund it? How do these companies, airlines fund it? Do you think, they fund it exactly the way you finance your car? I mean, to have a fleet of, think about it, to have a fleet of, uh, trans trans-Pacific, transatlantic, intercontinental um, uh, fleet, intercontinental flights, to have a fleet. You will need like, at least a dozen, Airbus 320 or Boeing 747. And they would, if one aircraft is, $10 million, to have 12 of them, right? That's $120 million. Where do they get that from? Huh? They borrow money. Why? They can borrow this money. Why? It's easier to borrow when you are uh, than a restaurant industry. Why? All these aircrafts are then put up as collateral, automatically collateral. If they cannot pay the debt, then the lenders can seize. They can seize these aircrafts and they can sell it off. They can recover their loans. So compared to, think about it, between a restaurant and an airlines, which business is more likely to be heavily leveraged? Airlines. You might say, oh, because the total asset size would be much bigger. No, not because of that. Airlines will have something to put up as collateral, whereas restaurants don't have anything to put up as collateral. What kind of collateral can a restaurant put up? Oven? Refrigerator? What kind of collateral value do you think they have? So that's obvious. I mean, so depending on the industry, some industries are more heavily leveraged. So basically, financial risk here means, debt, risk of debt, default risk, in other words, default risk. And business risk is, literally specific to the business, right? Think about it. If you are running a restaurant would be more prone to climate change than IT industry. Why? Because if Florida gets, hit by hurricane, weather events, something like, weather events, Florida gets hit by hurricane, the orange harvest is ruined. Orange harvest is ruined, right? Makes sense. Orange harvest is ruined. And then if orange harvest is ruined, then price of orange juice will go up. Any plate, right? Any menu that would have orange as a part of the ingredient, the menu price will have to go up. If the price goes up, then demand goes down. So in other words, that's something specific to that particular business or industry. Whereas hurricane in Florida doesn't affect IT industry, right? So that's the two. Those are the two sources of the risk. And then if you look at the risk is basically the volatility. So basically, it's the variance or the volatility in return on equity and earnings per share. Okay. Basically, they are all about variation in EBIT. Additional financial risk will cause additional variation in ROE and EPS. Basically, EBIT, eventually, it's EAT, right? After tax, interest and taxes, EAT. So eventually, from EAT, ROE and EPS, earnings per share, are affected. And financial total risk. The total risk they are talking about here is actually, they're not really talking about the total. They're only talking about. They're referring to this as the total risk, but actually, total risk but the reason this is the total risk. You have to include both systemic and unsystemic. This is the total risk. However, there is nothing you can do here about that. There's only something you can do with the leverage. There's only something you can do here, right? To unsystemic risk. So that's why they are saying this is the total risk. But now think about it. When we say leverage, actually there are two types of leverage. Usually when we say leverage, we refer to financial leverage. Financial, in other words, how much debt. So it's associated with the capital structure. It causes financial risk. However, there is also operating leverage. Leverage is literally, the boost you can get from using a lever and a fulcrum, right? And then, so operating leverage is, what is operating activity? Remember, operating activity is, what is operating? Huh? Operating, you remember, all companies are engaged in three activities, right? Investing activity, financing activity, and operating activity. Remember that? And the operating activity, that's from, income, right? Expenses. So income mainly comes from revenue, and then passive income, such as investment income. And then expenses, CGS, and operating expenses, OPEX, also cold, right? If you remember, this is variable cost, right? Direct cost, also called, direct cost, also called variable cost, fixed cost, right? Remember? So, and then subtracting expenses from income, you arrive at EBIT, or operating profit. Hence, that's operating activity. And in operating activity, the leverage means, so what is the composition of, what's the composition of variable versus fixed cost, right? Financial leverage is about the composition of debt and equity. Operating leverage is about the composition of variable cost and fixed cost. So it's the cost structure, and the cost structure is mainly determined by the production technology, right? Think about it. Most of the fixed cost is mainly what? Most of the fixed cost is plant and equipment. Isn't that right? In other words, most of the fixed cost is plant and equipment. So in other words, capital, right? Most of the capital usage is, from using capital. And then variable cost, although, it's capital, labor, and raw material, right? Capital, labor, and raw material. This capital is mostly, handled here, because, plant and equipment is capital, right? So most of it is, most of variable cost is labor and material. Now think about it. So it's the production technology. I mean, production technology determines the composition of variable cost and fixed cost. Now, the same product can be produced. Think about it. It can be. You might think some industries are more labor intensive. Some industries are more capital intensive. Yes, of course. For example, computer manufacturing would be more capital intensive than cotton farming, right? Obviously, in cotton farming and harvesting, there will be a lot of, more labor intensive. However, think about it. Even, computer manufacturing can be also labor intensive or capital intensive, right? If you hire a lot of labor, I mean, you may have seen these, films about, chip makers in China, chip manufacturing. There are a lot of factory workers there. Young girls, generally young girls, all sitting there, it could be labor intensive, but it could be, capital intensive as well. You can get rid of a lot of those labor, but by robots. Robots can, clean the wafer and, etch the circuit in the chip. So depending on, so think about it. The same industry, even if it is the same industry, it could be either capital intensive and labor intensive. If the more the fixed cost, which means more plant and equipment, right? More capital. That's called operating leverage. Operating leverage is higher when they use more capital, right? When they use more plant and equipment, operating leverage is higher. When they use more debt, financial leverage goes up. More capital, operating leverage goes up if they use more plant and equipment, more capital, right? And also, this causes variation in EBIT, right? So here's the, basically, variation is basically, standard deviation, right? Variation. Now, so this is, this has been already, discussed, so you can just take a look. So financial leverage, how does financial leverage, affects the stock price? Definitely, because, actually, I've been telling you, 100% equity firm, their stock price isn't really good. Rather, some debt. Actually, when you use some debt, stock price, the price, profit, earnings per share, and the stock price will go up. And that's why I've been telling you ever since, there is an optimal capital structure. Optimal capital structure, right? And I've been telling you, optimal capital structure comes from about 60 to 70% equity, and that means, about 40 to 30% debt. Empirically, optimal capital structure is something like that. So financial leverage may increase the stock price, and it increases the financial performance measured by return on equity and earnings per share. It may also performance worse, but unless you already have huge leverage. What's going on? But suppose debt goes up to 50%. If the debt goes up to 50-60%, that means equity goes down to if the debt goes up like that, then of course it can be worse. However, as long as you are not deviating from optimal capital structure, it will do good. Of course, it increases the default risk as you increase the leverage, right? So based on the return on equity and earnings per share, in good times, investors bid stocks price up as debt is increased from low. Yeah, you might. Investors bid stock prices up as debt is increased from low levels. Effect is eventually mitigated, but it will be mitigated. The effect will be mitigated by the increasing financial risk. Yeah, as I said, as the debt goes up, financial default risk, as debt goes up, default risk goes up, financial distress. Under what conditions will increasing leverage improve our, under what conditions then it will be positive? So here's an example. Take a look. Leverage analysis, Arizona Balloon Corporation, so ABC, Arizona Balloon Corporation. Everything is in $1,000, right? Three scenarios: 0% debt, so all equity, half equity, 80% debt. So up to this, that's like balance sheet. Debt and equity, 0% debt, so 100%, 1 million, right? And then shares at $10, 100,000 shares, right? If the price is $10. 50% debt, equity is 500,000. So of course, total equity, total assets, right? Still the same, 1 million. Now, however, if the share price is $10, 500,000 divided by 10, share price will be, there will have to be 50,000 shares, right? And 80% debt, then 200,000 is equity, right? Of course, total assets is 1 million. Now, number of shares will be 20,000, right? Because that divided by 200,000 divided by $10, right? Now, if they will make same revenue. Look, no matter under what capital structure, their total asset size, total assets is all 1 million. And with $1 million, I've been telling you, total asset size determines the production capacity. Total asset size determines the size of the firm. Size of the firm is, determines the, which means, production capacity. So they all have the same production capacity. With the same production capacity, they will they will produce the same output. Same output will be sold at same price. So the revenue will be the same. Now, let's say the cost is, the cost ratio is 80%. So variable cost, fixed cost, all, so EBIT will be all 200,000. And if they have debt, they pay, and the interest is 10%. In this case, there's no debt, so no interest. In this case, 10% of 500K, so 50. In this case, 80, right? EBT, earnings before taxes, right? This is earnings before taxes. The more earnings before taxes you have, the more taxes you will pay. Now, if the tax rate is 40%, 80 is their taxes. So EAT is 120. 40% of that is 60. 90 is their EAT. 72 is their EAT. So obviously you might think, oh, they did the best, they did like this. You might say. Oh, so 0% debt, 100% equity, all equity is the best. No, not necessarily. From the investors, from the stockholders' point of view, their return on equity is only 12%. It's the lowest because 120 over 1,000, 12%, 18%. This return on equity is 36%, right? So it may look like this, but actually from the investors, shareholders' perspective, it's like this. Earnings per share, the same. You divide, 72. You divide 72,000. You divide it by, total number of shares. 20,000. You'll get that. So look, this is the effect of right leverage. Zero leverage is not the best thing. Okay. If the profitability is good, okay. So this is, a clear illustration why capital structure is important. Okay. What? Okay. Is someone saying something? You gotta Tanbir, unless alrighty, Tanbir. I think your microphone is on. Okay. Anyway, well, this is, I guess, all the time we have. We have just about 7 minutes, 6 minutes left, but we can't go over. We will need more time to talk about return on capital employed. This is important. We're going to talk about this. Obviously, we'll have to talk about this next Monday. Okay. All righty. So, any questions so far? Any questions? Any questions? I don't think so.
Thank you, Professor.
No questions, Professor.
All
Have a
right.
good night.
All righty. All right.
Thank
So
you.
have
Thank
a
you,
great
Professor.
evening.
Have a
Bye
good
bye.
evening.
Great
Good night,
evening. I
everyone.
will see you
Good
guys
night.
all in face-to-face next Monday. Okay.
Okay. Enjoy your weekend.
F707.
Bye,
Okay.
Professor. Thank you.
All
Okay.
right.
Yes.
Take care, everyone.
Bye.
Good night.
Bye. Good night. Stop recording and sign out.